Welcome to Business Talk with me, Michael Avery, where we try and decode the markets from time to time and unravel investment trends. And I think try and make sense of why we willingly subject ourselves to the emotional roller coaster that is the stock market. Let's be honest, investing can feel a lot like dating sometimes. You start out hopeful, everything looks promising, then one bad earnings report later and you're questioning all of your life choices and wondering if you should have just stayed in cash. Well, this year we've seen the cracks in the US markets, exceptionalism. We've seen the revival of Chinese equities. Gold continues to be on a tear. And we've seen the ups and downs of specific stocks locally like Renogen and ArcelorMittal. And a lot of this fueled on uncertainty on the back of Trump's trade wars. Well, speaking of navigating tricky relationships, today's guest is someone who is no stranger to helping investors stay the course, even when Mr. Market throws a bit of a tantrum. Joining me is Wendy Myers, Head of PSG Securities, here to talk about whether it's still possible for individual investors to build real wealth through shares in today's topsy-turvy world. Wendy, welcome to the show. Great to have you back on.
Thank you very much, Michael. And thank you for inviting me back. It's great to be here.
I just want to chat to you about this market because it feels like it's got more twists and turns than a political drama series at the moment. We've got all of that global uncertainty. We've got local instability, the GNU, the budget, rates just won't make up their mind. For an individual investor looking to grow wealth, is it still realistic to expect success by investing in shares, or is this a game that only the institutions can win?
Yeah, most definitely. Look, as you know, I'm passionate about share investing, and I do agree with you. There's so much uncertainty at the moment globally and in South Africa, and I can understand why that can make investing very daunting for any investor, both seasoned and the young investor who's just starting. But I think it's important for all the listeners to understand that over time, we've seen that shares remain the one asset class that has proven repeatedly to contribute to growing wealth over the long term. I mean, markets going up and down is a natural consequence of investing, and it can be a bit unsettling. But I think your listeners need to understand that, those kind of market moves actually create good buying opportunities, but it's important for investors always to stay the course. I think I always say, don't panic about the market going down, because you want to have that equity exposure so that you can participate in the growth, and just have a clear strategy. Stick to it. I think the discipline is always necessary. And I think just a key point for me is remember that it's important to continuously invest. Don't put your investments down and just say, well, that's that. You need to consistently say, I'm going to add further money into my portfolio. I'm going to tweak my portfolio. And even for a high dividend income portfolio, don't let that money sit in cash for too long, because cash doesn't keep up with inflation. Make sure you reinvest that money into the market.
Yeah, there's a great book. I think it's called The Rise of the Optimist. I might be mistaken, but it's like 100 year of asset class returns. And over 100 years, it's beaten everything else? Shares over a long enough time horizon. So, especially if you're a young investor, get in the market, get involved. And over time, over 100 years, we're not cherry picking the data. The efficient capital allocation of the market, because effectively what you're doing is giving your money to the best and brightest CEOs, the listed companies who are really good capital allocators, and you're backing them to outperform. But you often hear the classic investment wisdom, don't put all your eggs in one basket, but shares still tend to be the go-to for serious wealth creation. What makes investing in shares so attractive compared to the other asset classes like bonds and money markets and ETFs?
Well, I think, for me, it's your opportunity, as you say, to benefit in the strategic direction of a company. That's why they say, choose wisely, choose a good stock. Don't be invested in it for a couple of months. Understand that, I think it was Warren Buffett, he said, if you're going to be invested in a stock, be invested in it for at least 10 years. If you're going to take the time to buy it, make sure it's a good one. And I think, money market investments, it's necessary. If you think of having cash in an overnight call account, it's necessary for a period of time because you want to take advantage of market movements. But be aware, interest doesn't keep up with inflation. Bonds can sometimes be a consideration as an asset class, but remember they are impacted by inflation. So when prices go up, then bonds, their returns are reduced. I think the only other asset class worth looking at other than shares is obviously unit trusts and exchange traded funds. They offer a more balanced return for investors. So yeah, that's definitely an option I think investors can look at. But I have my own preference for investing in shares, and I'll tell you why. You're able to, as an investor, decide how much exposure you want to a particular sector of the economy. Maybe you decide, I want to be more heavyweight in mining, or I like commodities. I like gold. I mean, it's trading at $3,000. Who would have thought, these days? But also you want to be able to say within that sector, I have particular shares that I'm interested in. I enjoy the product, or I believe in the management and their strategy. So I want to actually be a shareholder in that business and enjoy the benefits of them executing on that strategy.
Yeah, and I think when you start dipping your toes in the market, you realize just how enjoyable it is being an active shareholder in a business. And I think ETFs have got great benefits, low cost and whatever, but it does take away some of that direct interest that I think really sparks this huge passion for investing. That said, though, retail investors are known for making a few classic mistakes. We're emotional creatures. What are the biggest mistakes that you see individual investors making, and how can they avoid some of these pitfalls?
Yeah, I think, investors are, I mean, we humans, we're driven by emotion. We panic. And I think, investors need to understand they can't let this market noise get to them. Remember, a share will move up and down because of macroeconomic factors. It might have absolutely nothing to do with the actual share. Or in some cases, it might be that the share price is going up, whereas the market is generally down because the management of the company have obviously executed well on their strategy and they're reaping the benefits. So you want to have that exposure. You also want to make sure as an investor, you're not buying and selling too frequently. Why? Because it's costly. You're getting brokerage on that. You obviously capital gains tax on any sales, but you also want to make sure over time, because remember you invested for the long term, you want to make sure that you do tweaks to your portfolio along the way and you rebalance it. Because remember, as certain share prices go up and so some go down, the weighting in your portfolio changes. And you always want to make sure you keep that weighting between 3 and 5% per stock. And also not more than, I'd say on average, about 20 stocks within your portfolio.
And that's why it does require active engagement from that perspective. On the other hand, it also should be a little boring. You don't want to be chopping and changing every single day. So it's about finding that kind of balance. If you're someone who can't stomach the volatility of the market and you find share price movements a bit too nerve-wracking, what other investment opportunities should they consider? Are there smart ways to diversify risk while still aiming for decent equity-like returns?
Yeah, so that's where I think ETFs play quite a good role. I think investors sometimes they start here. I think that's probably for the young investor maybe a good discussion point. If I don't really know which share to buy and I really don't understand the difference from one sector to another, an exchange traded fund is I think a very good entry into the market. Gives you the sort of entry into having a market exposure, but the volatility or the change in the price isn't as material, if I can say that. ETFs obviously have their own minimum disclosure document. So as an investor, you can read up on it, make sure that it matches your risk profile. And it shows you in that disclosure document which sectors it's invested in, what the return is and what they aim to achieve, CPI plus X, just like a unit trust fund fact sheet. It's often an investment over multiple asset classes and industries, and you're actually benefiting from all the research that the asset manager is doing, making sure that the assets and the underlying in those ETFs are meeting the investment mandate. So it's nice. You're effectively leveraging the research that they're doing, and it's a good entry into the market, as I've said. Yeah.
Yeah, a great building block. Almost, if you want to get into the market, take something like an S&P 500, ETF, and you get kind of a chunk of the US market, which would have done really well over the last 10 years. I don't know about the next 10. Let's not get into that discussion because as we see, US exceptionalism is starting to lose its luster. But I think, investors are often bombarded with information, some good, some outright dangerous. How does PSG help individual investors navigate the noise and make informed strategic investment decisions?
Well, we like to pride ourselves on providing education to our investors. So we provide a lot of research, both local and offshore, on individual stocks. For us, we don't talk really around timing the market or sort of entry levels in. It's more around providing well-timed research so that the investor can read up calmly about it and understand how that share, if it interests them, will work in their portfolio to achieve their long-term goals. And in addition to that, as you go down your path of investing, Michael, I think, I'm expecting every investor, their investments in the market becomes more and more material. So it's important to then really reflect on if it's a journey you want to do on your own, or if this is something you want the help of an advisor to guide you in your portfolio construction. So that's where PSG has a wealth of financial advisors. They are specialized and licensed to assist you, the investor, in constructing a portfolio that meets your long-term growth needs and or your income needs. Remember, when you retire, that portfolio will be providing income for you to survive on. So your financial advisor is very critical in making sure you have enough to satisfy your spend.
And as we know, if you're going to retire, those properties in Val de Vie don't come cheap. I was chatting to Rake Nettling yesterday, starting prices of 7.6 million rand. So, but it's very important. I think you underline, when you get to that level, when you're starting to talk millions and tax planning can shave a couple of percent off here and there, you're talking about tens, if not hundreds of thousands of rands because of choices that you made either correctly or incorrectly. That's the importance of having good financial advice. Wendy, as always, you give us the best financial advice on stocks here on Business Talk. Thanks so much for your time.
Thank you so much, Michael. It's lovely to see you again.